Good morning, good afternoon, good evening to all you beautiful chickens out there. It's your boy Trey from Trey's Trades back again for another video. Like to my saying, I'm not financial advice, not financial advice. Please take it with a grain of salt. Let's get into the video today, my friends. You better buckle in, get yourself a monster, a bit of popcorn, because we're about to dive into an options and technical analysis masterclass. This is something that's been requested for quite some time, and to be frank with you, I've been on YouTube for a while, and I have failed. I have failed massively because I don't have one of these. People always said, Trey, you should just make your own, and I'd always just link Rain or Tail or this and that because it's already been done. Oh, the voice crack, that was good. But it's time to do it myself and walk through all the things that I personally use. And I've got it kind of layered out step by step by step. This is going to be chaptered out. So if there are things that you'd like to skip, just look at the little bar that shows how much time you've got left on the video down there or whatever. And you'll be able to go to whatever you want to. But this is going to be the premise behind what we're going to discuss here today. So we're going to start off with chart basics because I have an understanding of different people have different levels of understanding of how charts work, how options work, etc. And I go on kind of the levels of importance, I believe, and what I think to be the most in-depth. So we're gonna start off with chart basics. So time frames, RSI, MACD, volume, support, resistance, horizontal, and both upside, downside. I think these are all important things. So that if you don't have any understanding of charts and how they work, you can start here and work your way into the more complex sort of things. Then we're going to dive into technical patterns and supply and demand zones. These are personally my favorite thing to use. This is really what I use the majority of the time when I trade, is simply just technical patterns, supply and demand zones, and then also coming back to the charting basics, right? Time frames, RSI, MACD, volume, support, resistance. I try to layer these in, right? So volume being probably my favorite. This is probably the most important thing to me is volume alongside technical patterns and supply and demand zones. But we're going to walk you through flat tops, both a rejection and a breakout. We're going to go through a wedge, rising and falling. We're going to go through flags, bullish and bearish, head and shoulders, inverse head and shoulders, cup and handle, and an inverse cup and handle. That's what I, C, and H means. I, H, and S means. H and S, C, and H. Head and shoulders, cup and handle, inverse head and shoulders, inverse cup and handle. We're then going to dive into supply and demand zones. This is probably the most complex, maybe the most stretchy brain. You really got to kind of think outside the box when you look at this. And you also have to buy into the theory that algorithms and institutions are a majority of what move the stock market around. But fear not, as Trey, the dingus who likes monster hot dogs and Diet Coke, I'll tell you what, I'm going to show you proof that these do in fact work by looking at charts. So we're going to walk you through that. Number 3 on the list, because I trade options, that's what I like to do. We're going to have, sort of a understanding, a masterclass of what you need to know with options. And this is going to be prefaced by saying this is specifically for long calls and long puts, which means that you buy up front and then you sell on the back end, right? So you're giving up money and then you get paid money. That's the idea behind these long calls, long puts, which means that you're long, right? You're long on a put, you're long on a call in the same way that you're long on stock when you buy stock, right? We're gonna go over bid and ask, what these specifically mean, and then we're gonna go over the spreads because I don't think enough people talk about this. It's important to understand spreads and how liquid something is, because that is going to give you an idea of whether or not it's a really solid opportunity for you to make money. You want to keep as much money as you can. We're going to walk you through that. Open interest. We're going to talk about this. We're also going to give you a basic understanding of the Greeks, what I find to be probably the most important aspect of the Greeks. And then we're going to talk about in the money, at the money, out the money, and risk reward associated. After that, we're going to dive into exercising options. Personally, it's not worth it 99 times out of 100, but I am going to explain to you the one time that it is, because it's up to you individually to find out what trading strategy works best for you. Then I'm going to talk about risk reward, right? Runners being specifically the most important piece of this. And then strategy, scalps, swings, and exercising. These are sort of the 3 things that I find to be the most important with calls and, calls and puts, I should say. And then from there, I could probably add one more thing, and that's probably going to be leaps because this is even beyond just a swing, right? I do want to talk a little bit about how leaps work. From there, we're going to dive into number 4, which is a basic trading strategy. Now, this is a way. It's not the way. This is not guaranteed to make you money. This does not mean that this is the only thing you need to know about how trading works, because ultimately you have to figure that out for yourself. You take the things that I'm showing you, you see if it makes sense to you, and if it doesn't, you just got to adjust. You got to find what works personally for you. Day trading. So this would be thought of basically as scalping with options, right? You're getting in and out the same day. We're going to talk about entry points, stop losses, runners, and an exit plan. And then we're going to talk about swing trading: entry, stop loss, runners, exit. This is all going to matter, entirely on how much time commitment you have and what your trading strategy personally is going to be. And that is also going to impact and affect the tools that you utilize. From there, we've got one last thing, which is going to be the additional tools. Do not skip 1 through 4 if you don't have a complete understanding of 1 through 4. I don't think you should be looking at the additional tools, because that's exactly what these are, right? They're additional tools to help you make money. If you don't understand how to get a good entry, a good stop loss, how to take profit, that's the hardest part, is taking profit. Believe it or not, most people, they can get a trade green. They go, yes, baby, look at me, a screenshot, my 1,000% gain. I am master good. I'm so good. Trust me when I say, and I says, it's hard to take profits, right? It really is. So if you don't have an understanding of day trading versus swing trading, you don't understand how options work, you don't understand the chart patterns, you're not going to be able to use the additional tools, which are meant to stack on top of an already basic understanding of how to read charts, how options work, and how to take profits and how to enter a position. So we're going to talk through 921 crossovers. We're going to talk about 1348 crossovers, and then we're going to talk about the Williams alligator, because these are all things that I personally have in my Discord, and I am going to add one thing in here just because I feel that it is good to do so. Originally in my Discord, I do still have links that explain all of these different things, but essentially what this video is going to be is a homage that allows me to walk through and explain it in the way that makes sense to me. But if you want to look at this stuff, I first got my decent understanding of 928 from Conservative Collectors. He's got a 9+21 EMA trading strategy. You can see that right here, right? You can also look then at the 1348, which is explained by Review Dork. He'll give you an explanation of how this all works, right? So you can check this out. You can go through his entire video, and he's going to explain to you essentially how 1348 works, and you walk away, pretty decent. And then you can also go over to the Williams alligator. So I got my decent understanding of Williams alligator here from Trading Beacon. Best strategy for Williams alligator indicator explained. So I just want to be able to pay homage. In my previous video when I was talking about having these crossover setups algorithm coded into my Discord, I didn't say that. I merely just linked them, and I want to be able to give credit. So there's that for you. And we're going to start from the top and give you the beginning of the masterclass. And if you want to skip any of this stuff, as I mentioned before, just go to the chapter section and you're going to walk away pretty decent. So step 1, chart basics. Right now, if this is a situation where, let's just say that you are completely new to the stock market. You're watching stocks go up and down, and all you think to yourself is green is good, and you're buying the stock, you're buying a call, and you think, oh, it's going up, right? Well, from here, you got to have a basic understanding of charts. So what I want to start off with is time frames. Time frames is completely going to determine the way that you are going to approach any sort of specific trade, whether it be an entry, whether it be an exit. You want to focus on time frames and follow that up with a couple different things. So you have lots of different time frames on a chart. You've got a 1-minute chart. You can even go down to a 1 second if you'd really like to, which just means that each candle represents 1 minute of price action. A green versus red candle, if you don't have an understanding of that, that's okay. We'll walk you through it here really quick. A green candle means that the stock price went up, and a red candle means that the stock price went down. I'm going to highlight these accordingly. So this is green. Green is good. It means that stocks are going up. Red means stocks went down, right? So with that basic understanding, what you need to know is open and close. So here on this beast, a green candle opens from the bottom, meaning that the candle began at the bottom and it closes at the top, right? This would be the close. Red candles are the exact opposite. It opens at the top, meaning that at the beginning of that 1 minute, 5 minute, 15 minute, 30 minute, hour long candle, it opened at the top. and it closed at the bottom. You can also have what are called wicks. Now, the wick of a candle, you can think of as basically like the string noodle that comes out of, you know, sometimes you got a dingleberry that hangs down in your butt cheeks, whatever. This is price action that was tested but didn't hold. So let's just say for a green candle that the price opened here, but right when it opened, it pushed down and then it came back up all the way to here. This is price action that did not end up actually holding, right? So if you opened at the bottom of this green candle, it pushes down, and then let's just say it comes back up, and then from here it pushes up to the top of the candle, it pushes up to, let's just say, this level, and then it rejects, and it comes back down to the top. This is where it ended actually ended up closing. These wicks basically are just telling you, look, this is price action that was tested, it didn't hold. The open and close is as such, and the same thing can be applied with the red candle, right? If you opened here, it means that it tried to push higher, it rejected, came down, tried to push lower, it rejected, came back up. This is how it closed. That's what a wick will tell you, is rejection in either direction of a candle, right? So with that basic understanding, you can apply that candle method to every single time frame. A 1 minute represents 1 minute of candles. 5 minute represents 5 minutes worth. 30 minutes represents 30 minutes worth. You go to 1 hour, you go to daily, you can go to weekly, you can go to monthly, you can go to a 2 hour, you can go to a 4 hour. There's lots of different time frames, and the biggest takeaway for each time frame is a shorter time frame. And this is self-explanatory, but you'd be surprised. Shorter time frame equals shorter entry exit, right? So let's just say that you're watching a 1 minute candle. That's going to bear a lot less significance than a 1 hour candle. If you have a 1 minute breakout, a 1 minute chart breakout, there's a much higher probability of you getting juked out, especially if, let's just say that you're taking a swing position on a 1 minute breakout. There's pretty good odds you're going to get juked out on that, because charts, just by design, typically will test out levels over and over. They spend probably 70% of the time channel trading, trying to decide, should we go up, should we go down, in order to keep movement. So a shorter time frame, you're probably going to be seeing the rejections and the false breakouts more often than not. So a 1 minute is going to bear far less significance than a 1 hour. 1 hour breakout is going to hold far less significance than a 1 day breakout. A 1 day breakout is going to hold less significance than a 1 month breakout. You get my point here. Larger time frame is more useful for a longer trade. The shorter time frame is more useful for a shorter trade, for scalps, right? And we're going to dive into that as we sort of go on. So now that you understand sort of the basics behind time frame and how candles basically work, I want to dive into the RSI, MACD, and volume. And to me, out of all three of those, I find volume to be the most important. Ultimately, it's up to you. You have to decide what you believe is the most important tool to be able to utilize. But I use volume by far the most out of all three of these things. So we're going to start off here with the RSI. What is the RSI? Well, if you want to basically think of it, it's the relative strength index. This gives you an idea of essentially momentum between buyers and sellers. Typically, if it's close to 70, it means there's a lot of buying momentum. If it's close to 30, it means there's a lot of selling momentum. And if you're above or under either of those values, it can tell you essentially whether something is overbought or oversold, whether you can expect some form of a retracement. You can think of things very simply, right? Stocks move in waves, stocks move in patterns, and the RSI is basically tracking those waves and patterns. Anytime that you have a euphoric a rally basically referencing lots of buying pressure, you typically are going to have a retracement, which basically means you give some of that back. Anytime you have extreme fear, you're going to get some form of a bounce. This is just how stocks work, right? Nothing goes down forever. Nothing goes up forever. You always are going to see things wave, ebb, and flow. And that is what the RSI is essentially telling you. Now, the most useful part of the RSI to me is when you see a divergence of the RSI alongside price action, which we are going to dive into as we continue on. For example, you see that we have this downside level of resistance, which I'm going to explain here in a little bit, but at the same time, the RSI is starting to get some form of a bounce right here, right? You see this breakout of the RSI. If I could drop a line right here, I would show you, but you can see this higher, lower high. lower high, and a breakout. Well, that breakout didn't happen here yet, right? You see this breakout from this lower high setup on the RSI, and then you get a breakout from, you can expect the stock price to follow through eventually because there's a divergence there, meaning that something is crossing paths with another thing and doesn't quite add up. So the RSI is, I would argue, probably most useful for two things, right? You were looking for that sort of divergence, or you're using it to essentially just buy and or sell overbought, oversold territory. Oversold, overbought. That's probably the most useful thing about the RSI IMO, in my opinion. Ultimately, you have to decide, what you'd like to use it for. I think the divergence is probably the most useful. And this is probably, I'd say the RSI and MACD are tied in terms of importance to me personally. You have to decide what is the most useful tool for you, but I find that to be about there, right? Next thing's going to be the MACD. Now, the MACD is another useful tool to be able to show you sort of the ebbs and flows of buying and selling pressure. Typically, when you see the red, you can see that this coincides with, this is the MACD, by the way, MACD down here. The red coincides with moves to the downside. So you can see this move to the downside. You can see that it peaks right about here at the bottom of this price action, and it starts to curl back up. Well, wait a second, though, right? If it's curling back up, why is the price still going down? The MACD is probably the most useful for being able to predict a bullish rally, right? A flow back into bullish price action, essentially meaning that buyers are stepping back in to push the price back up. So here's another example of a divergence, right? The MACD is starting to curl back up, curling. The price has a small flush back down. You can see the MACD curled right here and is about to transition back into the green essentially representing another bullish move back up. Well, what do you notice, right? You can probably guess that there is some form of a divergence. The price is going back down. You would anticipate this to be some form of a dip buying opportunity if you wanted to buy a call, because it doesn't coincide with what the MACD is doing. The MACD is saying, hey, look, I could expect that at some point in the near future, you're going to get a bullish rally based on the 4-hour time frame, which means that maybe in the next 4 to 8 hours, you're going to see a decent move, which then actually end up coinciding, right? So off of that, RSI is pretty low. You can see, yep, this is oversold. It's at 18, which is a good dip buying opportunity. And then it got a bounce, right? That's a divergence. So there's a couple different ways that I think you could probably use the MACD. It's going to be basically almost the same as RSI, but I would add one thing and take away one thing, right? So divergence, I would be looking for divergence, essentially saying the price action does not match up with what this indicator, this tool is telling me. So if the MACD is saying that price is going to go back up soon, but the price is still going down, that's a divergence. That's something that you can pay attention to. The second thing that I would use it for is buying and selling peaks. So if you wanted to, let's just say buy a put, because we haven't talked about puts yet. You're looking at ARK. And what this has rocking right now. You see this peak right here, this 4-hour peak on the MACD, and then it starts to curl down, right? You see this candle right here start to curl down off that MACD. Well, what could you anticipate is that you're going to see some form of a follow through back into that red territory. You also want to take into consideration the long-term trend of whatever ticker you're looking at. We're going to talk about that here in a little bit when we dive into more technical patterns, right? But that is a tool that you can use in order to just simply ride waves, ride patterns, ride the ebbs and flows of bullish, bearish flow. That's really what that's probably useful for. The most important thing to me, though, is volume, by far. Volume is very useful, and the reasoning behind that is it can tell you when you're going to get a true breakout or a false breakout. Now, volume is nice because let's just use an example right here, right? Let's look at Bank of America. Now, Bank of America, I'm going to switch over to 1-hour time frame, and what you're going to notice here, very simply, is you have this downside level of resistance. I'm going to explain this in a little bit, but this downside level of resistance got broken out of. Well, this candle that broke out of that downside level of resistance, if you were to look at sort of the pre-market volume, what are you going to notice, right? Well, let's just look at this on the 5-minute. You can see that there was a huge uptick in volume right at the open as it continued to follow through. That's a good sign that you're getting a breakout. When you see a huge uptick in volume on moves, that indicates a lot of strength. That can be utilized in either direction. Here's another example, right? You're looking at Tilray, and you see this big move up, right? Candles are starting to move super, super heavy, and the volume just out of nowhere jumps. that volume indicates strength in the move. So I think that volume is the most useful for two specific things, right? Finding strength in the move, whether it's up or down, right? Strength in move. And it's also good for being able to find a true breakout versus a false breakout. Probably the best example of this is going to be AMC and GameStop. AMC and GameStop last week had a breakout of a very, very long-term daily pattern where they were in a downtrend for a very long time. And I'm going to show you this on the daily candles. This is a time frame, the daily, right? What do you see here is the volume upticks to nearly over 2 times as high as the previous day. That indicates to you that this is, in fact, a true breakout from this line right here, this downside level of resistance. Touch points, comes all the way down, breaks out of that. The volume follows through. The next day, volume was almost twice as high as the previous day as it broke out above the next line. That indicates a true breakout. Volume is super, super key for not getting juked out. And the beautiful thing about time zones, my friends, is you can use them, these patterns, these tools across all time frames, whether you're scalping, whether you're trying to swing trade, whether you just want an understanding of where a chart is for a long-term investment. This is applicable across the 1 minute, the 5 minute, the 30, the 1 hour, the daily, the weekly, the 4 hour, whatever you want to use. It's all useful information. So with that being said, support and resistance is the next thing, and I've already touched on this before, but support and resistance are essentially tough cookies to crack. You can think of this as like if you were to get a fortune cookie and you're smashing it on the table, and it takes like 5-6 smashes until that thing breaks. Probably a little stale. You probably don't want to eat that. I don't know about that. You know, you might want to go to a better Chinese restaurant, but nonetheless, that can be sort of thought of as support and resistance lines. So here's an example, right? I'm going to show you guys here really quick upside levels of support and resistance and downside levels of support and resistance. And we're going to use GameStop for this, right? So let's just go over here to GameStop and show you what I'm talking about. This can be thought of as a horizontal level of support. Support is what holds things up. So you can think of that as, it's tough to break this to the downside for sellers. Every time that it's tapped this, it kind of chops around a little bit. Chop meaning that it's not really picking a direction up or down. It's trying to determine whether it's going to break underneath this level or if it's going to bounce above that level. Every time that you see that chop and it doesn't know what to do, you can think of that as a support level and it bounces back up. In the same way that this is a resistance level. Rejected here, it's tough to break. And if it does break it, typically you can think of that as a breakout. And you want to watch the volume and the other things that we just previously discussed, such as MACD and RSI and all that stuff. That's going to be significant information. For example, you can see it broke above this resistance line, resistance being hard to break for buyers, and it bounced above it, bounced above that, and then acted as support, bounced back up. And you can see that it's being respected as both, whether it's above or below. Above this line, it's acting as support. Below that line, it's acting as resistance. And that's obviously a very key level. $148.65 for GameStop, for whatever reason or another, is very critical. Probably the most useful, though, this is by far, to me, this is what I use probably more than anything, is up and downside levels of support and resistance. And for that, I'm going to specifically use PayPal, right? Now, check this out. PayPal just recently had a 1 hour upside level of support, downside level of resistance, forming out some sort of a flag. Now, what do you notice here? Well, this support, I always look for at least 3 different touch points, touch point, touch point, touch point, touch point, to signify that it is a respected level of support. And the same way I'd look for at least 3 touch points for a level of resistance, touch point, touch point, touch point, touch point, and it rejected off of that level of resistance. Now, what happens when you break above or below these levels is they then act as either support or resistance, the opposite of what they were before. So for PayPal, right, had a false breakout of this level of resistance, came back down, broke beneath support, then it came back up to test, now acting as resistance. And you would expect that if it doesn't break above this, you're going to see a pretty hard move down going into Monday. That's something that you could expect. These upside levels of support and resistance can actually be key ways of identifying whether something is going to have a pattern back up or a pattern back down. And this is actually useful for bear flags, bull flags, rising wedges, falling wedges, which we're going to dive into here next. So you have a basic understanding of resistance, support. Give yourself an attaboy, a pat on the back, a golf clap, whatever, right? This is that's the starters. That's the starters of what I think is the most important for being able to trade. Next is going to be technical patterns and supply and demand zones. And the easiest way that I think I can do this for you is by simply drawing it out and showing you examples, right? So let's start off here with a flat top. A flat top is exactly what it sounds like. It's a top of any given chart. It's completely flat. It looks like this. And when you break above a level like that, or you reject off a level like that, it typically moves pretty dang quick. So to draw it out first, we're going to show you what this looks like. A flat top, this is a chart right here, and this is price. Let's just say that price is skirting around, skirting around, skirting around. It's starting to set higher lows. It's coming up, and it's obviously rejecting off of a horizontal level of resistance. You can think of that horizontal level of resistance as the flat top. And when it either A, rejects, or B, breaks out, big moves come. Typically with a rejection, you see a false breakout, and then it sells off super hard. That's the rejection off of a flat top. The breakout of a flat top, you'd be looking for something like this, where it breaks out, comes back down to test, and then it bounces, and then you get a big move off of that flat top level. Let's show you an example. Let's try and find something here really quick, right? So an example of this, to me, I think GameStop is a pretty decent one. Check this out. This is an obvious flat top level for GameStop. So you see a bunch of different touch points here. Touch point, touch point, touch point, touch point. Remember, I said 3 levels is the most important levels. Touch points, you want at least 3 of those to determine that something is in fact a key level. And when it breaks out above this, what do you notice? Massive move. Came all the way up to the next flat top breakout level, which was right here at about $149-ish. Now, if it was to reject off that, which it did back here, right? You see that's rejection off of a flat top on the 1-hour time frame. That rejection sold off pretty hard. Came from 130 all the way down to 106. Right? That is an example of a rejection, and this would be an example of a breakout of a flat top level, which is going to bring me into the next one, which is a wedge, a rising and a falling wedge. Now, just because you have a rising wedge or a falling wedge doesn't mean it's going to always follow that exact pattern, but it does mean that probability-wise, you're very likely to see it reflect one or two ways. A rising wedge, believe it or not, it sounds backwards, but today is opposite day. Rising wedge, that's kind of weird looking, is bearish. Typically, it means you're going to see a retracement back down. A falling wedge is actually bullish. It means you're going to expect some form of a bullish reversal off of that wedge. And that is utilizing something that we just went over before, which is upside or downside levels of support or resistance. So let's start off here with a rising wedge. Now, the example I'm about to show you is actually one of the 10 times that it didn't work. But I'm going to show you what usually would happen. This is an example of a rising wedge. And how do you know it's a rising wedge, right? You can tell by the way it is. No, it's because it looks like a wedge, but you have upside levels of both support and resistance. It's following a channel that's closing up to a peak, like so. And what typically happens off of rising wedges is it breaks down, like so. You would have expected AMC in this example, right, to break down coming off of this rising wedge. This is the 1 out of 10 times, probability-wise that it actually didn't do that. But this is what you would expect to happen. This is typically a bearish reversal indicator. And the way that you can identify it is upside level of support, touch point, touch point, touch point, touch point, upside level of resistance, touch point, touch point, touch point. Essentially think of support and resistance as connecting dots. If you can find a dot to connect, if you can find a touch point to connect, you want to connect them. Touch, 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 touch. Touch, 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 right? You connect the dots, you see them, forms up a wedge. You want to see the breakdown of that wedge typically is the next to follow. But the easier way to even do this is a breakout above either level. You're typically going to walk away pretty solid. So that's a rising wedge. The next one's going to be the falling wedge. Now, the falling wedge, this is much easier to show you because I can show you this on a daily time frame. But the falling wedge is the exact opposite. You see a stock doing something like this. You see it's forming up a wedge that appears to be falling downwards. You typically see a breakout of that wedge, right? Now, I'm going to show you a beautiful example of this right now with AMC. Now, check this out. AMC is a perfect example of a stock that's been in a falling wedge for the previous 9 months. Ever since June 2nd, all of this is done is bounce back and forth, back and forth, back and forth between this downside level of resistance, downside level of support. When it broke out, with the volume following through, utilizing one of the tools that we previously discussed, it came with a really decent sized move. This is a picture perfect example of how useful this is. And this is actually a good lesson as well, because we did have a 1 hour falling wedge, a rising wedge within this daily falling wedge, right? But this is useful to show you what we just talked about before, right? What is a more useful time frame in this scenario? Is it the 1 hour or is it the 1 day? It's always going to be the 1 day because this is representing a longer time frame of overall price action. The greater time frame is always going to beat the smaller time frame, meaning that if on the last week you've been trending bullish, but you have like a 5-minute rising wedge, which means that you expect price to retrace down, you have to also factor in that the last week of price action, the hourly candles are saying you're not really inclined to see this go that way, just based on the things that are presently happening, right? The larger time frame is always going to win. So keep that in the back of your mind when you're looking at this stuff. Next, we're going to go into flags. Now, a flag is very simple because it looks like exactly what it is. Typically, it means you have a long string of price action that's moving up. It finds some form of usually a flat top, right? Flat top resistance, and it bounces around. Bounces around, bounces around, bounces around, and it forms what appears to be a flag. Now, I'm going to paint this out for you super duper simple. This would be the pole of the flag. This would be the flag itself. Upside level of support, and this could be either a flat top level of resistance or a downside level of resistance. There's a couple different ways that you can look at flags, but this would be a bullish flag opportunity. And typically what you see is when it breaks out of that level of resistance, whether it's flat top, horizontal, or a downside, big move comes. The opposite of a bull flag, since this is a bull flag, it means that it is bullish. You would expect a bear flag, which would mean that typically it is bearish. It's the exact same thing, but it's upside down. A lot of downside level of price action, find some sort of a flat top support, and then it bounces around like this. Bounce around, bounce around, bounce around, bounce around. This representing the flag, except upside down. This would be the pole. This would be the downside level of resistance, either upside or flat top level of support, and you continue on. Give me 1 second to plug my light back in. I'll plug for some reason. There we go. And you would expect off of a break of this level of support, a pretty big move to the downside as such, right? That would be a bull flag and a bear flag. Now, there's actually an example of this happening right now with this stock. I would consider this to be a pretty decent looking bull flag. I'm going to paint this out for you on AMC here really, really quickly. But what you see here is a long string of price action to the upside, followed by what appears to be a downside level of resistance, upside level of support, forming out what appears to look like a flag. This is the pole. This is the bouncing back and forth. A break above this level, you'd expect a big move up. A break beneath the upside level of support, you'd expect a big move down, right? Now, this doesn't mean that you're going to guarantee yourself to see a breakout to the upside, right? But you also have to take into consideration, as I mentioned before, this is an hourly time frame. In the last day, the daily time frame, you just had a massive technical breakout. So you'd expect the greater time frame to bear more significance. So with that being said, a bear flag would be the exact opposite of that. It's a flag of price action that moves its way down and it bounces around, forms out what appears to be a flag. Typically, you see a breakdown to the downside. Which brings us into brings us into the next thing, right? Let's now discuss head and shoulders and inverse head and shoulders. So a head and shoulders pattern is very simple. I'm going to paint this out in the most simple way possible. Essentially, imagine you're at the store. You see this guy. He's got a face that looks like a guy. He's got shoulders, and he's walking, right? Well, essentially what you're looking for is the guy that looks like head and shoulders in price action as such. This is the head. These are the shoulders. Here and here. Bam. Don't you like that example? That was fucking beautiful. Doesn't get much better than that. And the most important pieces of this, there's 4 identifications that I usually keep track of with the head and shoulders and inverse. It's the same thing, but it's upside down, right? Head and shoulders, what you're looking for is the follow through of 4 things. You're looking for a flat top, which is this right here, acting as support. You're looking for a shoulder rejection, a false breakout head, a shoulder rejection. As such, this would form up some form of a channel, right? You can see a couple different touch points on this level of resistance, followed by a comeback down to the neckline of this entire pattern. This would be the neckline of the shoulder, and the head. Now, usually the neck is right above the shoulders, right? But in this instance, it's right down by our penis. So take that for what it is. It just is what it is. It doesn't have to make sense. It's just how charts typically work. And off of this head and shoulders, you typically expect to see a move to the downside. Inverse head and shoulders is the exact opposite thing, right? It means that you've got a neckline that's upside down, inversed, form up some form of a shoulder, some form of a head, some form of a shoulder, comes up, typically a move to the upside. Good thing. Head, shoulder, shoulder, neckline, channel, right? You see this this level of resistance right here at both the shoulders. This kind of looks like a ball sack in a wiener, but nonetheless, you can call it whatever you want. That's what the books call it, but you can call it ball and wiener if you'd like. This is typically bearish. Head and shoulders is bearish. Inverse head and shoulders, bullish, right? Now, this is something that the most important thing I can tell you is you're looking for these patterns. You're not trying to predict these patterns. So if you are trying to predict a pattern like this, you could get it wrong. You want to wait for confirmation, and we're going to get into that as we dive into the actual trading strategy. But if you see these patterns, it allows you to take an opportunity to make some money, to make a trade, right? The next thing I'm going to discuss finally is the cup and handle and the inverse cup and handle. Cup and handle and an inverse cup and handle, right? Now, what does this kind of look like? Typically, a cup and handle, what you're trying to see is a dip followed by a smaller dip, which is the handle, right? Now, check this out. This would be sort of the cup. This would be the handle. Forms out some form of a neckline, and usually you get a pretty decent sized break to the upside. So this right here is the cup. This right here is the handle, and it forms out some form of a handle. Typically, you can see some form of a downside level of support and resistance, this being the resistance, this being the support, followed by a move to the upside. Bullish. This is typically a bullish indicator. And what the most important piece of this cup and handle setup is the smaller overall dip, right? You have a big dip, followed by a little dip, little tit, followed by a breakout of some significant level of resistance. Inverse would be the exact opposite of this, right? You see a huge move up, followed by a smaller move up. It forms up some form of a channel of support and resistance, followed by a break down, right? Now, that is a inversed cup and handle. You can see the cup right here, upside down. You can see the handle right here. And then typically a pretty big move to the downside. Bearish. This is going to be a bearish indicator. And that is the last of the technical patterns that I personally use. Now, there are more of them. If you'd like to dive into more detail, it's very easy. What I would just look up is technical patterns on YouTube. You'll be able to find whatever you want, which is going to bring us into the supply and demand zones. And these, to me, are the greatest, easiest to understand stock market hack that I could possibly give you. I use these all the time for trading. I think they're very useful, and you can even use them alongside of all the previous technical patterns that I've just discussed. So let's dive into that right now, right? A supply and a demand zone. I call it a stock market hack because what they do is allow you to predict future price action with previous price action. Essentially, what you're looking for are levels that algorithms don't like. Now, this will tell you essentially where in the past algorithms have either bought or sold stock. So in order to understand this, you have to be able to understand the two things that these algos are looking for. Moves, meaning the 20-30% of the time that stocks either go up or down, and chop, the other 70% of the time when stocks are just doing this. That chop is information. You can use that information to determine where a supply or a demand zone is, and also what these mean. So first we have to understand what supply means. Supply means rejection. Typically, you'd expect a move to the downside. You can think of it in terms of economics, right? If you have too much supply, that means that demand goes down. If you have a lot of demand, typically that means the opposite. It means you'd expect something to go up, right? Supply will go down, right? So supply is selling pressure. Demand is buying pressure in the easiest way possible. So rejection down, rejection up. And I'm going to paint this out for you, right? Now, we're going to use the exact same chop as an example because this is what you're looking for to identify a supply or a demand zone. In this instance, we're going to use it as a supply zone, meaning a rejection. And over here, we're going to use this as the opposite. We're going to use this as a demand zone, right? Now, what happens if you touch these levels? Well, first, let's just pretend that we back up this chart a little ways to about here, right? Price is coming down, coming down, coming down. It touches this supply zone where there's a lot of chop and it rejects. Bam, down she goes. Comes up, breaks it, comes down. Now it's acting as a demand zone, and it usually has a big move back up. So if you want to understand supply and demand zones in the best way possible, I'm going to show you examples on a chart. Think of it as levels that algos don't like. You will have a rejection on either side of it, either to the up or to the downside. If you're underneath the price action, if you're underneath the box, it's acting as a supply zone, which means you can expect a rejection and a move down. If you're above it, it's acting as a demand zone, in which you can expect a bounce and a move up, right? Here's a couple examples. Let me show you this. I can pull up any ticker. This is universal across any time frame, any ticker, to give you an example, right? Let's start off with, let's just say, we'll do Snapchat. Check this out, because this is a very obvious supply zone right here. So what do you notice? You see some chop back and forth before a big move to the downside. These candles, what you're trying to do is capture all the candles that are chopping around, channel trading, not picking a direction either up or down before you got a decent size move down. And you might be asking yourself, Trey, well, what if this was based on news? The nice thing is, even if it was based on news, it's the exact same thing, right? Now, what I'm going to do is extend that box. I'm going to extend it all the way over here. And I'm going to show you how useful this truly is. And let me tell you, I haven't even looked at this chart until right now. I literally just looked at the last tickers that I've looked at, and I just picked one. And this is what I happened to pick. So the demand zone, origination, or supply zone, depending on which way the price is acting, came from right here, right? This is the origination of this supply and or demand zone, depending on where price action is operating. So with that being said, what do you notice? Anytime, this is the theory, right? Anytime it touches this box, when it's above it, it'll bounce. When it's below it, it'll reject. Well, what do you notice? Touches this box, bounces up. Touches the box, bounces up. Touches the box, bounces up. Touches the box, bounces up. But when it breaks the box, right? Now what? Touches the box, bounces down. Breaks above, touches it, bounces, touches it. What do you think's coming next? What do you think's coming? I'm gonna actually have to get a position in Snapchat on Monday. God damn, this looks this looks good. That is a picture perfect example of how supply and demand zone works. To me, it's probably the most useful pattern that you can use. It's the most useful technical analysis, because it's universal across all time frames, all tickers, and it's almost always respected. And why does it work, right? Because it literally is telling you exactly where algos buy and sell. It's telling you where. That's literally giving you the secret sauce. It's telling you where algorithms like to buy and sell stock, the specific price levels, right? Very, 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 very useful. So just to go over it one more time, because this is one of the more complex things to understand, right? Origination of demand zones or supply zones, it does not matter. It's universal across both, is the choppy price action before a big move either up or down. So in the exact same way, this right here, this little bit of chop would be a demand zone before this huge move up, right? And if we were to extend price action, if it ever came down to this, I think it would bounce very, very, very quickly. So it's the choppy price action, the consolidation, the channel trading before a big move up or down, and you just stretch that box of price action. That has now become a demand zone if it's beneath price action, or a supply zone if it's above price action. And you can expect a rejection in both directions. So that's a supply and demand zone. And we have just graduated level 2 of the options and technical analysis masterclass. Let's go. Let's keep going. Next up, right? Now we know how to identify a supply and demand zone and mark a supply and demand zone. Let's dive into options. I saved options for number 3 because I think if you're going to play in options, you have to have a basic understanding of how charts work and how to chart out a chart, right? So with that being said, the way that I personally trade options is specifically long, right? So both calls and puts, I play long, meaning that I don't really dabble in covered calls, and I don't really dabble in cash secured puts, which is going short on a call or short on a put. I'm not going to explain those here today. If you'd like to understand those, go look them up. Just look up a cash secured put or a covered call. You're going to get everything that you need to know. So we're going to dive into these specific things: bid and ask spread, and what the bid and ask is, open interest, the Greeks, in the money, at the money, out the money. These are probably the first things that you need to understand on how calls and puts work, so that you can walk away understanding what you're doing. So a call and a put is a bet that the stock price will either go up or down. They are leveraged ways to buy stock, essentially, right? So a contract, the most important thing that you can understand is a contract, one contract for both a call and a put, represents 100 shares in either direction. You are essentially saying, I have the right but not the obligation to either buy or sell 100 shares of whatever ticker. Just for this example, we're going to use Apple. I have the right, not the obligation, to buy 100 shares or sell 100 shares of Apple at a designated strike price, which is going to be SP. For a call, let's just say that you want to buy a $10 call. The $10 is the strike price for this specific example. Let's say that you want to buy a $10 put, 10p, $10p. The 10 is the strike price for this example, right? The 10 is the strike price. So with that understanding, one contract equals 100 shares. You then understand that there's some leverage behind this, that options allow you to leverage a little money to be able to make more gains. And you can understand how that kind of works by utilizing the Greeks and or an options profit calculator. I think the options profit calculator is the much easier way if you don't want to dabble, if you don't want to take the time, because let's be honest here, I don't sit in my head and crunch, like let's say the stock moved 30 cents up. I'm like, oh, the delta was this and the theta was that and the gamma was this. I don't do that. It doesn't really make sense. So the options profit calculator is going to help you sort of decide those things as things keep moving, right? So calls and puts, one contract equals 100 shares to buy or sell, the right, not the obligation. Let's dive into the bid and the ask, because this is going to help you determine exactly what you're buying, right? So to use this, we're going to come over here to Webull, and I'm going to show you the options chain for Snapchat. 01 April 2022 would be the expiration date, meaning that as time passes, this is the final day, 01 April 2022, that your contract will have value, whether it's intrinsic or extrinsic value, unless you decide to exercise it, right? We'll dive into what intrinsic and extrinsic value means as we go. This is the strike price right here, $17 all the way to $35. If I was to buy this as a call, which is what I currently have selected, let's just say that I was to buy the $27 strike price call. This would be in the money. I'll explain that in a bit. I would pay for this ask right here. When you buy stuff, you slap the ask. You slap it. You're slapping those cheeks. You're clapping booty cheeks. You're trying to say this is going to go up, right? So you buy that 27 for $8.50 per share. Now, I know that can be kind of confusing, but with the contract, you just want to move the decimal point 2 points over, right? Because this is $8.50 a share instead of 27. You're buying 100 shares for one contract, which means that contract costs you $850. Now, the ask is buying, so what would the bid be then? Selling. The difference between the two, $850 versus $830, that $20 in between, the market maker keeps when you sell your contract. So let's say that today, Saturday, obviously the market's closed, but let's say that I bought a snap call for $850, right? And I don't even hold it. 1 second later, I'm selling it, right? If I bought it for $850 and now I decide to sell it, well, the bid is $830, which means I'm selling it at $830 and I lost $20, right? That's if nothing happens. If Theta doesn't decay the value of your contract, if time doesn't decay the value of your contract, if it doesn't move up, it doesn't move down, you lost $20 simply to the bid and ask spread. Now, with that being said, the most important of the bid-ask spread is trying to find thin ones. How do you find a thin bid-ask spread? It's by finding very highly liquid open interests and options chains down the road. Now, before we move on from that, I do want to dive into the bid-ask a little bit more, just so you can understand, looking for a thin bid-ask spread, right? Now, this is actually a pretty decent one. A 6-cent difference per share, which is a $6 difference for the whole contract, $128 versus $122. That's a pretty good bid-ask spread. Why is that the case? It's because Snapchat is a highly liquid options chain, meaning that it's traded on a very frequent and regular basis, which is going to bring me into the open interest. Now, I pay very great attention to this. I think it's important. And this is actually a way to protect yourself as well from furus, the fuck faces that pump their bags. I'm going to dive into this for about 30 seconds because I think it is important. You want to watch open interest because if you see one of your favorite furus, which means somebody on Twitter who's saying, hey, buy this call, buy this put, but you look at the open interest and it's got 5 open interests, do not fucking buy it because that's the way that you can get scammed. What those guys are doing is called IV pumping you. They're basically using you to put money into the stock so they can pump their own bags. Don't fall for that, right? You want to find high open interest chains that have lots of activity. You can see that Snapchat has a high open interest, which just means that both long and short, there are lots of people who are playing these positions for a specific strike price. For example, let's just use the 36. There's 1,000 open interest for the 01 April, which means there's 1,000 currently open contracts for that $36 strike price on that call, right? Open interest is huge. A high open interest means there's a lot of activity that happens on that options chain. You want to find those because that is going to give you the smallest bid-ask spread. That brings me into the Greeks. The Greeks are by far the most complicating part of the options chain. And if you don't want to use it, in fact, I think the only thing that you really need to understand without a shadow of a doubt is Theta. If you don't want to understand Greeks, you at least have to be able to understand this calculator right here. This is called the Options Profit Calculator. I'm going to have a link down in the description box down below, but you can use this to figure out exactly how much you can make or lose by having a options contract, whether it be a call, whether it be a put. If you want to put, you click on long put, bearish. If you want to call, you click on long call, bullish. As an example, we're going to go to Snapchat. It closed at $35.38. Let's just say that at Friday close, I decided I wanted to buy a 01 April call contract for a total of, let's just say, the $37 strike. That currently costs you 68 cents a share, which is $68 a contract. And let's just say that I bought a single contract, right? Now, if the price is currently at $35.38, that would mean that I personally want to see this either A, go up to or above $37, or B, get out of this very quickly when it does make some form of a move up. Because the most important thing to understand with calls and or puts is you don't need them to reach your strike price. You only need them to go up and to manage your risk accordingly to Theta, which we are going to dive into. And that is going to be the Greek that I do spend at least some time discussing. You calculate this out. And what it's going to do is tell you that on the 26th, why does that say the 26th? We're close today, but nonetheless, let's just look at the 28th, which would be Monday, right? By Monday, in order to be at break even, if you bought this on Friday, you need this to be at $36 on the nuts. You make $0 in order to make 30%. Ish, right? 29.4%. You need this to be at $36.50. In order to make 64%, you need it to be at $37. In order to make 106%, $37.50. It goes on and on and on and on and on and on and on, right? But what you're going to notice is if I increase the top of the bracket to $40, what happens is the farther in the money this runs from out the money, the more you make. That's what's attractive about buying an out the money contract. And that's why people do it, is because you can make a lot of money if it actually does run in the money, because it's doing something that I'm going to explain as we dive into the in the money, at the money, out the money piece of the options course, right? The most important piece of the Greeks that you do need to know, though, so at least at the bare minimum, if you are going to trade options, is Theta. Theta sucks. This is what scares a lot of people with options. They'll buy something and they'll say, yeah, baby, I'm up 100%, baby. Let's fucking go. They got it on a Wednesday. And Thursday comes, their contract expires on Friday. And all of a sudden, it's not up 100%. It's up 50 or 40 because the price didn't go up. It didn't go down. Time simply just passed. That is Theta. Theta is the loss of extrinsic value, which is time in this instance, as each day passes. And you want to pay attention to the time frame. So for 01 April 2022 expiration, the $37 strike has an 8.6 cent Theta per share, which means that every passing day off of this contract, $68, you're losing $8.69. $8.69. right? Wild. That's if the price does not go up and it does not go down. These Greeks adjust as time goes on. But if you were to do the math, right, with each passing day, 5 days, if nothing happens, the stock doesn't go up, it doesn't go down, $8.60 times 5 is going to come really damn close to that full $68 contract. Theta is how much extrinsic value you are losing with each passing day. And that brings me into the piece that I'd like to discuss on extrinsic versus intrinsic value and in the money, at the money, out the money, all of these specificities that I find to be very important because this is going to designate your own risk and reward, right? Now, the last piece about options that I find to be very important before we get into exercising, risk, reward, and strategy is going to be the piece about extrinsic versus intrinsic value. So let's dive into that right now, right? Extrinsic value, god dang Microsoft. Extrinsic value is time. Extrinsic value is applicable to out the money contracts, which we're going to be talking about here in a little bit. Intrinsic value is real value. This is typically applied to anything that's at the money or more specifically, really deep in the money. Extrinsic value is the idea of this contract could be worth something if time passes. But as time continues to decay, which is theta, you lose that extrinsic value because there's less time available for it to gain intrinsic value. You can essentially think of extrinsic value as this has the opportunity to do something. Less time means less opportunity, means less value, means less money for that contract. Applicable for out the money, which will make sense when we explain out the money and the risk reward associated. Intrinsic value is the real value, and that's for out the money and the money. It's the exact opposite thing. It means that, hey, this is actually worth a nickel. If you exercise it, it has that value. The deeper it runs in the money, there's more value to it, obviously. And we'll talk about that now as we talk about out the money, in the money, and at the money. And I'm going to draw this out for you in the most simple way possible. Check this out. Out the money, in the money, at the money, I should say, and then in the money, right? Check this out. I'm going to have risk on one side, reward on one side. High risk, medium risk, low risk, low reward, medium reward, high reward. Now, what you're going to notice is in the money has the lowest risk and it has the lowest reward. Why is that? Because it has high intrinsic value. The real opportunity with leveraging, with options, is being able to go from extrinsic value, which is time, to high intrinsic value. Because extrinsic value is not worth as much as intrinsic value for an option, right? Which is why in the money doesn't have as much opportunity to make money. It's got lower risk. You're basically paying less insurance, right? You're not dabbling with the there's extrinsic value with this, whatever. You're paying more because you don't want the risk, but you also don't want as high of a reward. At the money is the middle. Medium reward, medium risk. It has maybe a little bit of intrinsic value and probably about medium extrinsic value, low to medium. Meaning there is still a little bit of time factor here because it's not in the money yet, but as it's close to at the money or slightly above at the money, it means that there's the opportunity for this to start to run deep in the money. I'm actually going to explain what these all are after I explain the high risk, high reward part of it. Out the money has the highest risk and it also has the highest reward. This is purely extrinsic value. There is extrinsic value. There is absolutely no intrinsic value to this. The value in these is time. The opportunity and why it has such high reward is because if it runs from out the money to in the money, it gains intrinsic value, which means that you can buy a contract for 20 cents and it can run up to 20 cents, meaning $20, up to, let's just say, $2, which is $200. You just 1,000%ed your gains, which is phenomenal. It's a 10x, right? But it's because it had super high risk. There was not a lot of opportunity for that to happen. Now, what does out the money, at the money, in the money actually mean, right? For a call for a put, it's different. I'm going to have a call right here. I'm going to have a put right here. Let's just say that this is Apple, and this is way back when Apple used to cost $10, right? So if you were to buy a call, we're going to have strike prices here. This is 7, this is 8, this is 9, this is 10, this is 11, and these apply also to puts, right? 10, 11, at the money, and I'm going to have this in different letters, different colors, so you can see. At the money is the exact price that the stock is currently trading at. This is at the money. $10 call, at the money. $10 put, at the money, right? Super simple. Next, we're going to talk about in the money. Now, if you were betting on a call, right? The stock price is currently at $10, and you decided that you wanted to buy a $9 call. This is in the money. Why? Because the strike price is below the current actual stock price. That means that if the strike price is lower for a call than the current stock price, it is in the money. The $11 strike, you can probably imagine, is out the money. And what this means is that the strike price is above, it's riskier than the current stock price. If you're to think about this logically, less risk in the money. If it's beneath the current stock price, strike price is, right, $9, that means that there's less risk associated, also less reward. So that would be in the money. Out the money having the highest risk being in red, $11. It's above the current stock price for a call. There you have it, right? Puts are the exact opposite thing. Out the money for this would be $9 because it's beneath, you're thinking that stocks are going down if you're playing a put. It's beneath the current stock price, which is $10, and in the money would be above the current stock price if you're going to be playing a put. This would be in the money because it is above the current stock price. It has the least risk associated in terms of out the money, at the money, in the money. So now we understand what these mean, what they're applicable for, the risk reward associated, what extrinsic value is, which is time, what intrinsic value is, which is the actual value of the contract. We want to dive into now probably the most important part, which is exercising risk reward and a strategy. Now, exercising is very simple, right? Exercising a call, if you get a out the money, for example, that runs in the money, you have the opportunity to exercise that. Let's just say that the strike price of Apple was $11 and now it's trading at 13, right? $13. Phenomenal. You made it, right? You have the opportunity to exercise that call. In a call situation, what that would mean is one contract equaling 100 shares. You could buy, if your strike price was $11, 100 shares for $11 instead of what the current stock price is, which is 13, right? A put is the exact opposite thing. A put is, let's just say that the price went from $10 down to 8 and you had a $9 put, right? Now you have the opportunity, the right, not the obligation, one contract equals 100 shares, to sell 100 shares at $8 or $9 instead of 8, right? So if you had that $9 strike, now it's trading at 8 or 7, you get to sell 100 shares at $9. This is only valuable. Exercising to me is only valuable if you believe that the very long-term trend of whatever call or put you have is going to continue. For example, if I could go back in time 10 years and buy a whole bunch of Tesla calls, right, for $50, and I believe that 10 years from now, that stock is going to be worth $1,000, $2,000, $3,000. I would exercise. I would much rather have the shares available to be able to exercise because I know that the stock is going to continue to go up. The company is going to continue to improve. If you're a trader, exercising 99 times out of 100 is not in your best interest. But I do want to tell you that so that it is available knowledge to you if you do believe in doing so, right? So keep that in the back of your mind with exercising. That's going to bring me next into risk and reward, right? So now we understand it's sort of how calls and puts work. We have to understand a basic strategy. I'm going to walk you through mine. I'm not telling you what to do. You ultimately have to find what works for you. But my strategy with options is very simple. I want to identify an entry. I want to identify a stop loss. I want to identify where I'm going to be taking runners in percentage gain or by stock price or whatever. And then I want to determine where my exit is going to be. So a risk reward in this sort of situation is going to be for a stop loss, for example. I'm willing to risk, let's just say that I have one contract of a $10 call, and for this $10 call, I paid $100, right? I'm going to risk 20% of that. So your stop loss then is going to be 20%. A runner is going to be, once I am up, let's say 30%, and this is where discipline and rules come into play. Let's just say that once this is up 30%, I'm going to take 1/4 off the table. 1/4, if you have 4 contracts instead of 1, right? I'm going to take 1/4 of those off the table. So you'd sell one. You'd sell 1 contract, which will leave you with 3, right? That's now you have 3 runners. Let's say that up 70%, you take another one off the table. Now you only have half, right? That would leave you with 2. Let's say at 100%, you take another one off the table. That would leave you with 1 contract, right? I'm trying to do the math, but I'm too stupid. That would be 1 runner, right? It's essentially checkpoints along the way where you're trying to decide for yourself where you want to take profit, because the most important thing with an option, in my opinion, is don't let a green trade turn red, right? And don't diamond hand options. Diamond handing options does not work. You cannot win. You're literally fighting market makers, because just inherently your options contracts are meant to expire worthless. Think about this, right? They write these up every single week, so they must be making money on them. How do they make money? By them expiring worthless. How does something expire worthless? If you diamond hand it, right? Most of the time, it is worth taking profits, even if you could have made more. That is the beauty behind a runner. So now we understand a stop loss, which is, this is the most I'm willing to risk for the reward of, let's just say, a runner before a full exit. Let's say that you want to make 100%, or it caps out at, let's say, 80%. You see it start to go down. You have to determine that exit for yourself. But these are the 4 steps of a trading strategy with options that I find to be the most important. So going through all of that, if there's anything that you don't understand, I'm going to have this linked up here. There's going to be an info card where I walk in greater detail through both calls and puts, so that you can get more hands-on information about how that works. But those are sort of the big things that I find to be important. The last thing being a leap, right? Now, if you're going to scalp an option versus swing an option versus exercising, the strategy is going to change. We've talked about risk reward, runners, entry, stop loss, runners, exit, right? Having those 4 things sort of determined for yourself. You have to understand where they're actually applicable, right? Scalping, swinging, exercising, all different things. A scalp is a day trade. It means you're not going to hold that option very long. Sometimes it's 1 minute, sometimes it's 5, sometimes it's 10, sometimes it's 30 minutes, sometimes it's an hour, right? But a scalp, you plan on exiting on the day. It's going to be a different time frame, different tools, different this, different that. So you're going to utilize for a scalp versus a swing. A swing is something that you'd hold overnight. This is maybe something you'd hold for a day, 2 days, a week, a month, right? Whatever. Then you've got leaps, which is a very long-term contract. Maybe you believe that a stock is at $100, so you buy an $80 put that's a year out because you think a year from now, the market's going to crash, or this stock is going to go bankrupt. That's going to be a leap, right? Call. Let's say this price is at $100. You buy a $120 call for a year from now because you think the price is going to go up to $140 or something, right? That'd be a leap. You're paying for the opportunity for a long-term investment by also leveraging a lot of money. That would be your opportunity at a leap. Exercising, I think, is only useful if you are in a leap sort of situation, but at the end of the day, it's up to you. I want you to be able to determine for yourself what kind of trader you are, what you would like to accomplish. These are things that I would check boxes on and look into more depending on how much time commitment you have available to you, how much risk tolerance you have. Typically, scalps I find to be a little more risky, shorter time frames. There's more opportunity for some fuck shit to go on, right? Determine these things, right? It's very important. I think that's everything I want to cover for options. That should be it, which brings me into a basic trading strategy, and that'll bring me into the final thing I'd like to discuss today, which is additional tools. So my basic trading strategy, and this kind of ties into exactly what I was talking about before, is going to be different for day trading than it is for swing trading. Myself, I am much more of a day trader than a swing trader. Very, very rarely do I overnight a position on an option. I'm going to tell you exactly why. Ultimately, this is up to you. You get to do whatever you want to do, but this is what works for me. Think about the after hours and pre-market, and the thing about options as well is you cannot buy or sell options in the after hours or pre-market. So why is that problematic, right? Well, if you don't want a diamond hand, a call, or a put, you don't want to have risk on the table. It's something that you cannot control. I personally don't like that, right? I don't like, let's say that I've got a great setup. This represents the pre-market. This represents the after hours. And I bought a call right here, right? The price is going up. It's flat topped out. I buy a call. Bam. It gets a huge move up. It's moving. It's moving. It's moving. And all of a sudden in the after hours, dumps. For whatever reason or another, maybe bad news, maybe something happened, maybe it just rejected off a level, right? You can't sell here. You can't sell here, which means I don't like that. I don't like that opportunity. So I'm a day trader. I'm a scalper. I typically get in and out of stuff this exact same day if I'm playing call or put contracts. You also usually use shorter time frames for this, maybe the 5 minute, maybe the 15 minute, maybe the 1 minute, maybe the half hour, maybe the hour, whatever. For a swing, you're using a much broader time frame. This is typically more leaps. You want to look at the daily candles, the 4-hour candles, and you're not really sweating the ups and downs in the very short term, right? You have to determine the risk tolerance for you on whether you're okay with the uncontrollable of the after hours and the pre-market, right? You can't buy and sell here. You have to accept that. So that is why I personally am a big scalper. With that being said, things that you probably want to know for scalps, right? Shorter time frames are useful. So I use the 1 minute, the 5 minute, and the 15 minute pretty religiously. I find these to be very useful. Typically, I keep a pretty tight stop loss. So I would use between 15 to 20% or so. I typically take a runner profit, meaning that, hey, I'm going to take profit on maybe a quarter of my position after something is up, let's say 20 to 30%. And then I have another check mark at maybe like 50, another check mark at like 75. And I'm going to leave that last one for whatever happens, that last quarter of my position, right? That's scalping. I think scalping is important if you don't like the after hours or pre-market, the uncontrollable of both of those specific factors. You want to determine an entry, you want to determine a stop loss, you want to determine a runner, you want to determine an exit. There's more aggressive entries. There's less aggressive entries, and that's ultimately up to you. You can take bounces off supply zones, demand zones. You can take breakouts, rejections off of different technical patterns. We've basically spoon-fed you a whole list of different things that you can use, and then it's up to you to digest that information and decide for yourself what makes the most sense for me personally and my risk tolerance. You want to determine all 4 of these things: entry, stop loss, runners, exit. Same thing for swing trading, except you are accepting the after hours and pre-market action, which you cannot control, right? If you're wrong, you can't control, you can't get out of that. You can't really use your stop loss. You just have to eat it in that specific moment, right? And you're using a larger time frame. I think swing trading, the 1 minute, the 5 minute, the 15 minute, far less useful to you. I think you're probably going to want to pay more attention to the 15 minute, the 1 hour, and the 4 hour. Now, I want to say one thing, however, right? For day trading and for scalping, I think that the 1 hour is still useful for one thing: macro trend. Macro trend is very important because if you are on a 1, 5, 15 minute break up or down within a 1 hour or a 4 hour bullish or bearish trend that's divergent to whatever position you're trying to take, that's going to impact the likelihood of whether you're playing a false breakout or a true breakout, right? Very, very important. So keep that in the back of your mind. And I say that because the last piece that I want to dive into is going to be the additional tools. These are things that I personally have in my Discord right now. It is absolutely free. You don't have to pay anything for this. It's completely available to you. It is these 3 indicators, which I just gave credit for in the beginning of the video: the 9/21 or under 21, the 1348, and the Williams alligator. I have a very solid walkthrough on what all these different things are laid out for you in this Discord. But basically, your big takeaway is going to be this: these crossovers are additional tools that allow you, right? That allow you to be able to walk away with all this extra information with some help. And these are 1 hour time frames. So the reason that I say the 1 hour time frames are useful to you and that are important to you is because you want to be able to use everything that we just discussed, which is the hour time frames, the wedges, the breakouts, the supply zones, demand zones. Apply that to a bunch of different time frames so you get the entire picture. And what these 921 crossovers or the 1348 crossovers are telling you on that 1 hour time frame is that, hey, on this 1 hour time frame or this 5 minute time frame or this 5 minute time frame or this 3 minute time frame, obviously a greater time frame equals greater significance, greater trend, there's opportunity here. From there, off of a fire off, for example, let's just look at, we had a 921 1 hour fire off at 12:11 p.m. It was a 9 under 21, which is bearish for Starbucks, right? So we're just going to pull up Starbucks right here and look at what this actually looked like, right? Looking at the actual chart, what do you see on Starbucks? Well, if you look at the actual daily, first thing I would do is look at the daily and see what's kind of happening here. You can see that it's at a bottom, right? It's found some form of a bottom, but there is also a gap fill spot here. A gap fill, typically, you can see some form of a reversal back to the downside. Typically, when a gap fill happens, you will fill that gap. I'd be looking for this sort of gap fill spot. Right now that I've looked at that fired off on the hourly, what do you see happened is it rejected off of that, right? Now, why is it? Well, it's probably because this gap fill is acting as some form of a demand zone. It doesn't really want to cross underneath this. You also have another demand zone over here, right? So these fire offs are essentially ways to get you to look at specific things, having the knowledge that you already understand about technical analysis, about patterns, about breakouts, about this, about that. Apply it to that fire off and then make a decision on what makes the most sense for an entry, for an exit, for your runners, and for your stop loss. Right? It's a tool. It's an addition. It's the sprinkles on top of your German chocolate cake that allow you to say, this gives me some extra confidence to take a setup. Let's find another one really quick, just so I can give you an example of what a good one looks like, right? 921 on the Amazon on the 1 hour time frame. Let's come over here to Amazon. Let's type this in here really quick. What's the grand scheme picture, right? So the first thing that I would be doing is I'd look at the daily candles. What are the daily candles looking like? It's right around a flat top level, right? Amazon's right at a flat top level. So there's sort of two opportunities to happen here. Either it's going to break out of this big, massive double bottom George W sort of setup. I am wearing a George W shirt right now, by the way. Pretty wild stuff. It's either going to reject off that and bounce down pretty hard, or it's going to break out very, very hard. So on the 1 hour time frame, what you saw with Amazon, this fired off. If we come back to the Discord, this fired off at 11:03 in the morning. If I was looking at this on the 1 minute candles at 11:03 in the morning, that would have been right about here, right? Well, what I notice is this. We're going to draw some levels. Connect the dots. You can see a bunch of dots here. I'm actually going to get rid of the Williams alligator here really quick. I do have an explanation on that in the video that I just recently put out. I'm also going to link that in the description box down below in case you missed it. I see this, and I see this. Dot, 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 break under the dot. I'll take that. That looks like a pretty good trade, utilizing everything that I already know about technical analysis and patterns and this and that. Looking at the grand scheme of things, looking at, hey, this has the opportunity to reject off of a pretty gnarly flat top setup right now. I'm just trying to apply all the things that I see based on what this bot is firing off to give me the best opportunity possible. Which brings me to the last thing that I'm going to discuss, which is how do you know if the bot in my Discord, and there is going to be a link in the description box down below if you want to hop in this, because it is absolutely free. It'll stay free. We're going to update this every single month. It uses the most liquid options chains, which means tight bid-ask spreads. I can't IV pump you. We're not trying to fucking scam you. These are all blue chips, so there's no way to really do it, right? We're just keeping it honest. We're not giving you specific strike prices, nothing like that. We're giving you opportunity. 9 under 21 or the 9 over 21 are the exact opposite of each other. 9 under 21 means a put, means bearish. 9 over 21 means bullish, a call. Same thing with 1348. You look at this 1348 right here, 13 under 48, bearish, a put. 13 over 48, bullish, a call. The greater time frame equals greater confidence equals you can hold it longer, right? So the 5 minute is not going to bear as much weight as the 1 hour. The 3 minute 921 will not bear as much weight as the 921 5 minute, will not bear as much weight as the 921 1 hour, right? These are accessories, the sprinkles to everything that we just discussed, 1 through 4. Basic understanding of charts, basic understanding of technical patterns, supply and demand zones, of how options work, about a trading strategy, applying all of these things to a fire off from an alert, and then from there you can make a decision, right? Williams Alligator, same exact thing. I do have a video for that right now. If you would like to check that out, it is my last video on my channel. I have a really cool announcement. I explained that to you. If you'd like to check that out, that'll also be linked down below for you. That is everything that you need to know about these alerts and crossovers. So I think that's basically everything I wanted to touch on. That was a long ass video. It was an hour and 18 minutes, but I wanted to be able to walk through basically everything that I find to be important. I might have missed some things. I certainly glided over some things because I wanted to be able to dive into what I find to be the most important, what I utilize personally. And the last thing that I can say, and I'll send you on your way because this is long enough, is you have to decide what's best for you, right? I will not tell you when to buy. I will not tell you when to sell. I'm not going to promise you some cookie cutter bullshit that's guaranteed to work, because the truth of trading is a lot of it falls on you as an individual, right? I don't know what the stat is, but it's over 90% easily of traders lose money. And that's because trading is hard. It's a very difficult thing to do. You're not set up to succeed by market makers, by institutions, by the system itself. You have to find a way to beat the top of the pyramid, the tip of the pyramid. Those are the guys you're competing with, right? And in order to do that, you have to know the game. So to know the game, you got to put in time. You got to study. I watched this video 3, 4, 5 times through. That's what it takes. That's what I did, right? I watched Rain or Tail for probably 150 hours before I took my first trade, because I understood it's hard. You see the stats, you see everything about it. And it's important to know that, right? You're not guaranteed to win. I'm not going to pretend that you are, but I do want to at least set you up with the best opportunity to do so. And I think that's about it. So that was a long video. I think that's about all that I got for the day. And if this helps you out, drop a like. I have a join button if you'd like to tap it. That's cool. My Discord is absolutely free. The join button will give you nothing but a sub badge and some emojis. It's just a way to support the channel if you'd like to see more things down the road. And that's all that I've got for you. So until the next one, guys, I appreciate you tuning in. Light taps as always. Much love and peace.